It's halfway through 2026. Hello, my name is Kevin Warsh from Core Wealth. We're going to be talking about financial markets and what's been happening around the world to the end of June 2026. If we have a look at what's happened in equity markets around the world, developed markets were slightly softer for the month. We also saw continued geopolitical turmoil happening. On the back of that, we actually saw the oil price improving down to $73 a barrel after there was progress with negotiations between the US and Iran. However, we did see some of the technology stocks coming off quite a lot as there were further concerns as to whether the whole artificial intelligence build-out would actually generate the returns that were needed. So we saw tech stocks coming off quite a lot, but other areas of the market actually did reasonably well. And we've seen the value sector of the US market, for example, being up quite strongly so far year to date, close to 15%. And the more growthy type area of the market, which is where your tech stocks typically sit, that's only up around 5% year to date. We've seen emerging markets soften a little bit, and that's mostly been because of the China portion of that market. One of the key drivers of that is that there's been some slowdown at a macroeconomic level, and that's been where retail sales have slowed down, and that's really because people aren't shopping as much as they did before, and it's the first negative reading that we've seen since COVID. On the other hand, emerging markets usually do well when the dollar is weakening, and recently we saw the central bank in the US, firstly they haven't cut rates, and secondly they may start increasing rates soon, and that has dampened the appetite for emerging markets. If we have a look at the South African equity market, it's down for the second month in a row, and so far now year to date is down around 3%, after having been up at the end of February just over 10% prior to the start of the US and Iran war in the Middle East. If we have a look at what's happened recently, the gold price has come off quite a lot, and we've seen that weighing on the South African gold miners. And then we've also seen the effects of the higher oil price coming through into South Africa's inflation and into the imports that are coming into South Africa. However, we are expecting the oil price to improve, and it already did during June, but will still be volatile, we think, for a while. But as those numbers feed out of our inflation figures, we think the rand will continue to strengthen. Year to date so far, it is still already 1% stronger. Let's have a look at the markets in a little bit more detail in this next table, and you'll see for the month as a whole that, as I mentioned previously, developed markets and emerging markets were both down for the month, but there are some areas of interest where we saw markets doing particularly well. And you'll see the green numbers for June of Japan and Europe, both of them up quite nicely. And Chinese equities, but the local portion, that's what the CSI 300 is, was also up quite nicely for the month. But if you have a look over the longer term there, you can see that emerging markets have definitely been an attractive place to be over the last 3 years. Other areas that have done well is also the Japanese equity market, up over 25% a year for the last 3 years. And then places like Europe, UK, and even local China and the US as well, up really strongly over the last 3 years. Let's have a look at the South African markets. This is now in South African rands, not US dollars. And if you have a look at the table, you can see equity market down, as I mentioned earlier, but listed property up quite strongly, as were the local bonds in South Africa. If you have a look over the longer term, we can see both over the 3 and 5 years, some really attractive returns from South African equities and listed property, in fact. If we have a look over the 5-year period, I'll tell you what the numbers were. On the international side, you were getting 11.5% on a global equity portfolio, developed market. You get another additional 2.8% because the rand had weakened against the dollar by 2.8. So you're just over 14%. But in South African equities, you got 15.2 per year over the last 5 years. So the last 5 years have been a good time to have exposure to the South African equity markets versus what you had globally. And that's particularly important for many South African investors whose liabilities are in South Africa, and hence they have a large portion exposed to South African equities. One of the strategies that we've been using for a number of clients, and we added into our models not too long ago as well, have been South African hedge funds. In this section, we're just going to talk about that strategy. And on this graph that you can see here, we show how the hedge funds have performed, and we've compared them to two things. One, to the Johannesburg Stock Exchange, which is the all-share index, which is the green line, and then also to the multi-asset flexible category. It's not an entirely comparable peer group, but it's the closest that we've got. And the reason it's not that comparable is because hedge funds, while they are very active, similar to the multi-asset flexible category, they are allowed to short shares. In other words, when shares go down, by shorting it, they actually make money when shares go down. You can see that the hedge fund managers have been competitive, actually outperforming the all-share for most of the period, but at much less volatility. So the line is a lot smoother. The returns are a lot smoother than the all-share index. And that for us is a big win for clients. We're getting great returns by choosing really good hedge fund managers, but actually generating much less volatility than had they been just invested in shares. So we have 5 different managers in our hedge fund strategy. One of the managers is 36ONE. The fund is run by one of their founding members, Cy Jacobs, a very experienced portfolio manager and someone who's run this fund very, very well over the last number of years. The fund now is just over 8 billion rand in size, so a sizable fund, but still managing to add good performance. And all we've compared it to here is the red line just being compared to cash if you'd have had money in the bank. The green line is comparing it to inflation, and you can see that compared to the inflation line, some significant outperformance over time, which is what we aim to achieve for clients. This next graph just has a look at our overall hedge fund strategy, where it's invested, what asset classes. And you can see, if you just go from left to right, that there's about 26% of it is invested in South African equities, and quite a big chunk currently invested in South African bonds and cash. And the blue lines, as opposed to the purple ones, are the peer group of that flexible, multi-asset flexible peer group. And you can see that much lower exposure to equities at the moment, much higher exposure to bonds and cash. And that is really just demonstrating how active these hedge fund managers can be in moving between the different asset classes, but all of them have substantial long-term track records of showing their ability to do this well. You've heard us speaking a lot about how much is being spent in the coming years on the infrastructure for artificial intelligence. Hundreds of billions of dollars, over 700 projected just for this year, and that could be over $1 trillion per year in the next 2 years. We're going to have a look now at how will that impact South Africa, if at all. To understand the impact of the AI infrastructure build out on South Africa, we're going to start in the US. And here is an estimate of the second quarter GDP growth or economic growth in the US. And we can see in the middle of the graph there that it shows that the GDP forecast is expected to be 1.4% growth for the second quarter. That is below the long-term average. But the reason it's below the long-term average is the last line on that graph, which shows a negative 8.9%. From net exports. In other words, they're importing things, and what they were importing are memory chips, which are being used in these massive data centers and in the infrastructure build out for artificial intelligence. And that gives you an idea. Now, while the rest of the US economy is actually growing very strongly, that importing actually feeds through into the final number that shows it being a little bit slower. So let's have a look at what other things may need to be imported. These two graphs just have a look at where those imports into the US have come from. And you can see on the graph on the left, the red line just showing Taiwan and the blue line showing South Korea, both two areas where you've got companies like Taiwan Semiconductors in Taiwan and SK Hynix in South Korea that are producing memory chips that are used in a lot of this artificial intelligence. So how will all of this affect South Africa? One of the key areas that is going to be impacted globally is the need for additional energy. And the estimates at this stage are that the electricity demand is going to increase from 77 gigawatts in 2023 to over 300 gigawatts by 2030. Now that's only four years away at the moment. That's an increase of the equivalent of between 7 and 9 times what we use in South Africa as a whole country. That's the additional demand that's going to be needed. While there'll be a need for additional energy, there's also going to be a need for long duration storage and backup power systems. And this is an area where hydrogen fuel cells will play a critical role. And importantly for South Africa, 70% of global platinum supply, which is a key catalyst in these products, is produced in South Africa. And so the AI boom leads to additional electricity demand. That means there's more demand for gas, for nuclear, renewables. The grid's going to need to be expanded, and there's going to be a need for reliable storage. And that impacts on hydrogen cells, and because of that, there's additional platinum that is needed. You can see on the graph on the right that the demand for hydrogen is going to be more than 20 times what it was back in 2023 within the next 5 years. So we've just explained how that will increase demand for platinum. We've already seen the price starting to react. And on the left-hand side, you can see that graph, which is the platinum futures price, already spiking just recently, and much higher than it has been for a longer period of time. But what will this do for South Africa? If we take the example of what happened in 2026, where we had the high gold prices and platinum was already up a lot, there was additional tax revenue of some 80 billion rand in South Africa, and this meant there was a windfall of just over 21 billion rand that Treasury received that it wasn't planning to receive. And this meant that they were able to avert a tax increase they were planning, and it also enabled them to move the tax brackets for the first time in 2 years. So if we continue to see this demand for platinum coming through, we think it creates this virtuous circle that we show on the right-hand side here, that we see fiscal revenues increasing, in other words, more taxes being collected. That lowers our risk as a country. So people around the world looking at South Africa's bonds go, hang on, things are their South Africa's balance sheet is improving. That means there's increased demand for our debt. So people are paying less on debt, which will be good for the economy. They have more money to spend on consumables and other things, which will make the economy grow faster. Thanks for watching. I hope that gives you some insights into some possible tailwinds that may be coming South Africa's way. If you have any questions, please get hold of your financial advisor or drop us a comment below.